Hi everyone, how's it going? In this video, we're going to talk about Palantir, trading under the ticker symbol PLTR. Right now, there are massive movements coming out of the stock, and it would be very important to stay up to date with the latest price movements, especially knowing that many people watching this channel and many others on YouTube have a lot of shares in Palantir. In this video, I'm going to cover the technical aspects and how the stock performed over the recent trading sessions in order to identify what should be the overall approach with the stock. Before the video begins, just a quick heads up that my videos are based on the trading sessions that are already completed, and not all the videos are recorded on the same day they're posted. So if there are material events that happen afterwards, I'm going to make follow-up videos to reflect those changes if need be. With that being said, let's begin with today's topic. Palantir has intrigued the financial market and traders since the day they were introduced to the stock exchange. With the shadowy and seemingly influential financial backers, a name coming from the Lords of the Ring, an eccentric CEO, and a company that is leading the way to both an economy of data and of post-Silicon Valley, Palantir is more than a data company. It is a flagship that represents a lot of the sentiments of our time, and this is why it is an interesting company to look into. Other than the fact that, many people have a significant chunk of their portfolio and their life savings in it. And the fact that its platforms seem to be head and shoulders above the competition is also the reason why I believe that this company is going to be one of the sector's key players in years to come. Palantir is a data analytics company founded in 2003 and is headquartered in Denver, Colorado. It develops software platforms and applications to better understand the data flow and optimize the operations. Palantir has an appeal to the market because it does have a solid reputation built in a relatively long time and has a lot of established relationships with major federal agencies and obtained many long-term contracts as a result. It operates in many sectors including automobile, legal, natural resources, and finance. The platforms it develops are Palantir Gotham and Palantir Foundry. The trading volume of Palantir has recently been 38.9 million shares, compared to an average volume of 53.9 million shares. Over the previous 52-week period, its price fluctuated between $11.75 and $39.22. The market cap of Palantir is currently at $26 billion, compared to an enterprise value of $45 billion. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. Some of the examples of impact by leverage is if the company has a lot of debt, then the market may feel uncertain about a company's capacity to pay back its interest and principals, which then negatively impacts its profitability, attractiveness, and even solvency at one point. One key element to note regarding the enterprise value is that for many growth-type companies, one of the most significant assets they own is the goodwill. Goodwill is an expectation of the market that the company can generate more profit or to have more growth than another company. Basically, it is the assumption that this company is going to do better than others because it may have a good management, stronger brand recognition, or bigger online following. It is basically what is unique about that company in particular compared to an alternative competitor. In other words, it's not a tangible asset that companies may use, but it's often the reason why some companies are perceived to be trading at a discount and some others are traded at a premium, because the market cap may be lower than the enterprise value when it includes that piece of goodwill. But in case the company goes to liquidation, though, goodwill would be completely depreciated, and we would be left with potentially less assets to distribute to shareholders and debt holders than the figure currently shown on balance. In comparison to its historical price fluctuations, the stock is 10% higher than the 1-month low, 10% higher than the 3-month low, and 10% higher than the 52-week low. On the options market, which often gives a hint on the market sentiment on where the stock price is likely going to head toward. The implied volatility is 85.2% compared to a historical volatility of 56.4%. The put-call volume ratio is currently at 0.64. It is normal for most stocks to tend to have a higher put option volume than what they truly deserve because many institutional investors systematically choose to hedge their exposures by buying put options. The most recent volume of options traded has been 137,000 contracts in a day, compared to the 30-day average of 176,000. In terms of open interest, the most recent volume of open interest was 3.2 million contracts, compared to the 30-day average of 3.4 million contracts. Regarding the shareholder structure, institutional shareholders own about 34% of all outstanding shares. The biggest shareholders include Vanguard, BlackRock, and ARK Investment Management. It is relevant to an extent to know the shareholder structure, because it does help to determine if you should hold the stock long-term or to view it as a short-term volatility trade opportunity. If the stock is mainly held by retail traders, then it can be a sign that the stock lacks the depth to justify long-term trust. Usually, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment, and not just a short-term trade. This is obviously subject to some exceptions, since many great companies are mostly held by retail investors and not by institutional ones. But that, at least till now, tends to be the exceptions and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price goes down. Sometimes when there are significant short interest in the total volume, it can be a sign that there are operations going on, like concerted operations going on against that company. The current short interest is just 6.1% of the total float, and 48.2% of those transactions come from the dark pool. Now, let's take a look at the indicators. Financial indicators give us a suggestion of what the price movements are showing, and it can be used as one of the elements to determine what should be our overall approach. The oscillators are showing 0 sell, 9 neutrals, and 2 buys, with an overall tendency of buy. The moving averages of the past price actions show 14 sell, 1 neutral, and 0 buy. The overall tendency from the perspective of the moving averages is to strongly sell. Keep in mind that indicators often show the present and the past, but rarely predicts accurately the future. Nevertheless, I've found that they're quite relevant to determine if your timing of the trade is the right one. In terms of pivot points, which are levels of support and resistance calculated by the algorithm sprinkled in the price trends, the support levels are $7.68, $12.41, and $13.06. For the resistance levels, they are $14.36, $19.15, and $21.86. Recently, the stock of Palantir Technologies has struggled in the market, that's plain to see, partially because of the Q3 results and the conclusion of some market participants, and if I may say so, significant market participants, about its growth potentials, and partially because investors have been unwinding their positions on growth stocks in general. It's going to be interesting to see whether the share has what it takes to start going up in the upcoming week. Over the past 30 days or so, the stock has lost more than 30% of its equity value, but seems to have found solid supports near the $12 level because it bounced off twice from there and has decided to move up for the moment. There's no guarantee, of course, on where the stock is going to end up, but I believe that the biggest wave of sell-off is now behind us, and we should see some positive movements coming back in soon. Of course, if we look at the stock performance of Palantir over a year, The sell-off is even more obvious since it reached near the $40 level at one point before the sell-off was initiated. It managed to hold for some time near the $25 level, but ultimately it wasn't able to push upward in a challenging environment overall. I think that the long-term recommendation should be positive and to adopt an overall bullish view on this stock. However, in a market condition that is now more challenging than ever for growth stocks, or at least very challenging compared to what we've been having over the past 24 months, we must also reconsider the timing and amount of exposure that we're willing to put in Palantir. With that being said, I think that going in Palantir now is a good choice, but keep in mind that we're still early in this attempting effort of Palantir to go back up. My suggestion is to keep an allocation between 3 to 5% of Palantir and to buy in very small batches every time the price falls. The current price point suggests that it'll continue to hold, and we should see within the next couple of weeks whether the price would support the idea of buying more from there onward. In this current market environment, I believe that we should be careful about taking positions and risk in the financial market in general, and in the equity market in particular. Because over the past decade or so, the financial market has been living with the help of newly created capital from QEs, resulting in a massive increase of asset prices and the corresponding decrease in their yields. And the low interest rate also contributed to reinforce this phenomenon because the financial sector would see its profit margins reduced and in turn keeps the returns of other sectors and employees low as well. At the same time, the market doesn't represent the real economy, and the real economy doesn't get reflected in the price of different securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. If the asset prices only depend on the fundamentals, then their performances in the Northern Hemisphere would have been more than mediocre, because things have been mostly stagnant over the years. A few things can explain why asset prices managed to remain high despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their own economies. But because that money is distributed to banks and expected to loan to businesses to create more jobs, and that in fact there aren't that many opportunities out there, this money became capital that travels around the world and went into the huge financial melting pot. The QEs are now wrapping up in many countries, so I don't think that it'll remain as the main driving force over the next couple of years to keep the asset prices up. But it's compensated by the arrival of new capital from different regions to North America because it's perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be sustained over the next couple of years, if not intensifying. The last phenomenon is the creation of artificial bubbles that are either supported by real market trends or completely fictional ones to allow market participants to play the game of hot potato and to either create profits or to safekeep their capital. The EV sector back in 2020 is an excellent example of this. But nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially from Asia. What this means for the market and for us is that the volatility is supposed to increase over time, which will provide opportunities to make a profit or to incur losses, depending on the timing and risk management. Another thing to note for this period of time is that we have to be very careful about having shorts. It's already riskier than having longs because the losses of shorts are not limited, right? Because there's no limit in terms of how far the stock can increase. But with the increased involvement of short sellers, I believe that the stocks when shorted will have an even higher probability of getting squeezed, which will result in potentially massive losses. So we're also observing more of an irrational behavior from market participants in the sense that very often people will choose to rush in a position not necessarily because the fundamentals are convincing, but because there's a buildup of demand in a specific stock and people will pile in to ride the gravy train with the rest of us. That kind of behavior is highly risky and may result in losses. It's worth pointing out that in 2020 and probably in 2021, the market has never presented that many opportunities, but it was also during that same period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. Positions should begin small, so that there is an opportunity to average down later. And specifically for the growth stocks, I think that 5 to 10% overall should be a healthy weight for the portfolio. And each stock should represent about 1 to 3% of the positions. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.